Where is the stock market? What is a stock? How do I get started in investing in stocks? If you want to get started in stock market investing or just want to know the answers to these questions, then this video is for you. In this video, we're going to take a look at the history of stocks, where they originated from, as well as what is a stock and what determines its stock price. We're also going to take a look at some stock investing terms such as PE ratio, market capitalization, as well as what are dividends. We're also going to go over where you can start investing in stocks and how you can start investing in stocks today. Stock markets began during the New World around the 1500s when Christopher Columbus landed in America in 1492, when Dutch merchants wanted to send over large ships to the New World in order to begin trading different silk, spices, and other foreign goods. But in order to accomplish this, they needed a large amount of money to begin doing these trades, a large enough amount of money that one person did not have at the time. So these merchants pooled their money together. That way they could raise enough capital so they can begin trading. Each of these investors then became co-owners of these trading companies. These ventures were called joint stock companies. Thus, these shareholders began selling and trading the pieces or the amount of ownership in the company that they had to other people. And from that, the stock market began. By the way, if you're enjoying the video so far, please make sure to hit that like button and don't forget to subscribe if you haven't already. Joint stock companies became so successful that they actually started to spread all across Europe. As the number of companies increased, it became clear that there needed to be some sort of centralized marketplace where people were allowed to sell and buy pieces of these companies. As a result, stock traders began meeting at a London coffee house that they later called the Stock Exchange. Thus, the very first stock exchange, the London Stock Exchange, was founded in 1801. This became known as the place where traders could go buy and sell shares of companies. Fast forward to today's time period, and now we have several different stock exchanges, such as the New York Stock Exchange, the NASDAQ, and the Shanghai Stock Exchange. Wrapping up our little history lesson, we now know that a stock is just a little piece of a company. It originated from the need to pool money together in order to fund these large companies. It requires billions and billions of dollars to create these really large companies such as Coca-Cola, Apple, and Microsoft. Because of this large capital requirement needed to start some of these really large, great companies can go ahead and offer an IPO or an initial public offering where other people can go ahead and continue to pool their money into the company. Yes, so even to this day, this idea of pooling your money together to help create this large business is still used to this day. We can go ahead and take a look at a stock such as Facebook, let's say. Facebook became public in 2012. So that means in the year 2012, people were allowed to pool their money into the company so the company could actually get more money and thus use that money for whatever investing and operating costs that they required. And remember, because now you've given your money to this company, you are now a part owner, though a very, very small part owner, depending on how many stocks you buy, of this company. So if you were to buy just one share of Facebook, you're going to be about a 0.00001% owner of Facebook. But if you were to buy millions of shares, you would be closer to, let's say, 1% owner of Facebook. Before this IPO, or again, initial public offering, the company would have been considered private and would have to find ways to raise their own capital privately in their own kind of ways, where maybe they could get loans from the bank or call up, maybe close friends that they know that are millionaires, just saying, and get them to invest into their company. But when the date of the IPO hits, also known as when the company goes public, they can publicly trade pieces or shares of the company so other people can go ahead and buy and pretty much fund the company. Now, quick note, you might have noticed that I'm using shares and stocks quite interchangeably because they mean pretty much the same thing, except shares is a unit of measurement. So for example, you can say I have stocks in Microsoft, right? But you wouldn't say I have 5 stocks in Microsoft. You would say I have 5 shares in Microsoft, something like that. So again, shares is more of a unit of measurement, whereas stock is you own stocks in the company. So now you might be thinking, what exactly drives the price of these different stocks? What drives the prices of the stock market? Now we can go ahead and Google the stock price of Microsoft. If we take a look, we'll see that the price is around $202 per share, as well as we can see that the market cap is at $1.5 trillion. It has a PE ratio of 35 and a dividend yield of about 1%. Market cap, or market capitalization, is the total market value of the outstanding shares of that company. So technically speaking, if you had $1.5 trillion just laying around somewhere, you could go ahead and purchase Microsoft entirely, the entire company of Microsoft. Looking at the share price of Microsoft at around $202 and the market capitalization at about $1.5 trillion, if you were to buy one share of Microsoft stock right now, you would technically be a part owner of the company and own 0.0000001% of Microsoft. On the flip side, let's say you had $100 million and you wanted to invest into Microsoft today, you would actually have about 0.06% ownership in Microsoft. Now, when you own 0.06% of the company, that means you own 0.06% of all the assets of that company, as well as 0.06% of all the profits of that company as well. We also saw that they have a dividend of about 1%. So that means for every share of Microsoft that you have, they will pay you 1% over the year that you own the stock. Now, normally when companies pay their shareholders, at least in the United States, it's pretty common practice to go ahead and pay your shareholders quarterly throughout the year. So that means that you'll get paid about 4 times in the year. And because Microsoft pays 1% of the stock price that you currently would buy it at, each quarter they're going to go ahead and pay you 0.25% of the stock price that you bought it at. So that within 1 year you own, or you've been paid back 1% of the price of stock that you bought from Microsoft. So simply put, a dividend is just an X amount of money that a company pays out to its shareholder for owning that stock. The company has looked at its financial statements and said, you know what, we own so much money, let's go ahead and give some back to our shareholders as a thank you for owning part of our company, for owning some of our stock. If you were to update the current price of Microsoft, or the current stock of Microsoft selling right now, you might have seen that it actually changed. Now, what causes the price of the stock to fluctuate up and down? Well, in its most basic form, it's simply a game of supply versus demand. The current stock price simply reflects the amount of money a person is willing to pay for part ownership in Microsoft. Normally, most people who are trying to buy a piece of Microsoft have already looked at the financial statements and agree that, you know what, at $202 a share, I think it is a fair price to go ahead and try and buy one share of Microsoft stock. In the short term, a stock price can actually be very volatile, and that's why it can be risky to go ahead and invest in the stock market. A lot of people aren't able to handle the whole emotional toll of the stock price going up or the stock price going down. Though in the long term, it is not so bad. It actually starts to stay with the financial statements and stay at a fair value. Again, over the long term, it tends to correct itself over time. There are things such as bad news about the company or changes in management that can cause the actual stock price to go down despite the fact that the financial statements have not changed. But again, over time, in the longer term, it tends to correct itself and stay at around a fair value compared to the financial statements of the company. One more term we wanted to take a look at is the PE ratio. PE ratio is known as the price to earnings ratio. It's a simple ratio comparing a company's share price to a company's earnings per share. Normally, the lower the PE ratio is, the more undervalued it is. So if you see a company, let's say at a PE ratio of 10, then we can go ahead and say that the company might be overvalued. Whereas if we see a company that has a PE ratio of about 30, we could say it's close to fair or perhaps overvalued. Now, it is also important to note that it does depend on the sector that the company is in. So for tech companies, a PE ratio of 30 might be a fair value, whereas a PE ratio of 30 for perhaps airline companies might be overvalued. So far, we've looked at what causes the price of a stock to either go up or down, the PE ratio of a stock, as well as the market capitalization. Now that you've learned all these new terms and the history of the stock, you might be thinking, well, how can I go ahead and start investing in stocks right now? I want to go ahead and get into it. Well, if that's the case, you want to go ahead and sign up for a stock brokerage account. Now, there are many different stock brokerages that you can go to. Now, the ones I personally use are Robinhood and Webull, as they're very easy to use and quickly accessible on your phone. There are other stock brokerages that you can use as well, such as Charles Schwab, Fidelity, and Vanguard. Normally, these different companies will have a website where you can go and sign up for an account. And once you sign up and you're approved, you can go ahead and begin trading. Normally, they're going to require that you put in some sort of down payment, let's say anywhere from $100 to let's say $1,000. And once they see that and you get approved, you can go ahead and begin trading and investing in stocks. If there's a company that you love, that you've been wanting to invest in for a while, I'm going to also go ahead and leave some links down below where you can click on and be able to sign up either with Robinhood or Webull and begin investing today. I hope you guys enjoyed today's video. Again, if you gained value from this video, please make sure to smash that like button and don't forget to subscribe down below if you haven't already. Thanks for watching.